Any long-term investment is intrinsically tied to the pace of interest rates. However, when interest rates begin to fall, what was once a hindrance becomes a driving force. This shift represents a tailwind, a salutary shift. At the same time, a phenomenon has emerged that we could call the safeguard reflex, particularly poignant in the world of artificial intelligence. If a competitor advances into innovative territory, especially in the field of AI, and I remain static, the risk of being swallowed up by this vortex is real. Therefore, it becomes imperative to act quickly, matching, or ideally, surpassing, the pace of rivals becomes a matter of strategic survival. Artificial intelligence has catalyzed this urgency in an abrupt and tangible way, something inconceivable a decade ago, when Nvidia was still seen as a timid potential beneficiary of this tectonic shift. Today, there is no doubt that AI has captured the collective imagination, both in the corporate spectrum and among consumers. The advent of ChatGPT served as the initial spark, precipitating a frantic race to decipher the ramifications of this revolution. Companies seek strategies to tame and direct this force, while consumers try to understand how it will reshape their interactions. Investors, in turn, grope in the dark in search of the epicenter where value will be deposited. But look beyond the obvious figures. Companies like Tesla offer a fascinating glimpse. The automaker has developed its own AI chip, pushing back the use of Nvidia chips. Google and Meta have followed similar paths. Custom hardware is now king, custom-designed parts, abandoning the generic paradigms of the past. In the software space, the current reality is equally intriguing. Giants like Nvidia are trading at multiples of 25 or 26 times their revenue. Note, not profit, but gross revenue. In contrast, software companies like Twilio display modest valuations, at levels of twice revenue, an unusual scenario. Many others do not even exceed single digits. The market logic has been reversed, where previously software had higher multiples and hardware was penalized with lower scores. We are living in a unique era. From an economic perspective, the productivity gains that AI can bring could come as a surprise. Corporations are hungry for AI. They see it as the key to efficiency and cost-cutting. But why the frenzy? Because pricing power is slipping through our fingers. The pandemic was an anomaly, a time when logistical bottlenecks allowed companies to dictate prices. That era is over. Now, the wind is blowing in a different direction. Our analysis points to an abrupt economic landing, a more severe scenario than the consensus anticipates. And it is precisely during periods of shock and recession that companies and individuals become more receptive to changing paradigms. We are on the brink of that threshold. We have warned. The landing will be rougher than many imagine. Even so, we have seen resilience in the stock markets. Does this sound contradictory? Not at all. The innovation world has been through a tough winter over the past 2 years. 2022 marked an unprecedented bear market for disruptive industries. Tech stocks, for example, have plummeted more sharply than they did during the dot-com crash, when the ecosystem was not yet ready to absorb innovation. It is important to remember that cloud computing only took off in 2006. AI had its rebirth in 2012 with deep learning, and transformer architecture only emerged in 2018. The bubble burst in the early 2000s because there was excess capital and a lack of technological maturity. The technologies were green and the cost was prohibitive. Today, we are experiencing the opposite. Development costs are spiraling downwards. AI is the prime example. The model we now know as ChatGPT, if conceived in 2015, would have cost $800 million United States dollars. In 2020, it cost around $5 million United States dollars. Today, it could be developed for less than $500,000. By 2030, we estimate that the cost will be around $30 United States dollars. We're seeing a 70% annual drop in the cost of training AI. That's unparalleled. That's more than double the pace set by Moore's Law. And that opens the door to an unprecedented acceleration in innovation. Consider Nvidia's trajectory. After reporting a 3% drop in revenue in April, it is now projecting 63% growth in the following quarter. This reflects the speed at which consumers and companies are embracing this technology. In short, we see a hard landing ahead. While much of this is already incorporated into pricing, it will be an uncomfortable process for companies that have lost control over their pricing and are facing margin compression. This will force them to embrace innovation faster than they ever thought possible. Innovation will become more than a choice, it will be the only viable response to eroding profitability. An illustrative example is Home Depot. The company has reduced its same-store sales forecast for the year. It now expects a decline of between 0% and 5%. And this, despite the favorable scenario. Many families are not moving because of prohibitive mortgages, and remodeling has become a logical alternative. Even so, the company projects a decline, both in volume and in price. But the market did not punish the stock severely. Why? Because we had already gone through a bear cycle the previous year. The market, in its tacit wisdom, anticipated this wear and tear. What does he see now? That interest rates and inflation are likely to fall much more than previously expected. And although the focus is on the tech giants, there are two ways to interpret this phenomenon. The pessimistic reading. The market is thin, favoring few stocks, a dangerous sign. This view has come true in other eras, such as the 1960s and 1970s with the Nifty 50 and the dot-com bubble. The optimistic reading. This type of concentration usually precedes an expansion, especially when the macroeconomic backdrop improves, with interest rates and inflation falling. Our view remains clear. The biggest risk is not inflationary, but deflationary. And fixed income markets have been buying into this thesis since last October. That month, the yield on 10-year treasuries peaked at 4.3%. Today, it has fallen back to 3.7%. Another telling sign. Bitcoin and other cryptos have risen in value amid the regional banking crisis. This shows that for many, Bitcoin, and, to a lesser extent, Ether, are already operating as safe haven instruments, just like gold. This realization led us to reinterpret the role of innovation. Today, it is no longer just a promise, it is an anchor of stability in uncertain times. What for years was seen as a risky bet has come to be seen as a strength in the face of macroeconomic volatility. In times of falling interest rates, what was once a stumbling block becomes a springboard. And innovation, far from being a burden, becomes the indispensable engine of progress.